Mind Radio podcast. I am Brian Ramsey along with Eric Douglas and Tad Douglas.
Hello.
Thank you.
And that was, if you're watching this on our YouTube channel, Tad was over there scrambling for his mic. He forgot his mic. We kind of rushed into this. Anyway, all right, so thank you for joining us today. We are talking about just, things that you should be, things that you might consider to take advantage of during market volatility. So just so you know, we're recording this show. It is May 15th, 2020. So we're right in the middle of this pandemic crisis. And so we've had a lot of negative news. That's the thing is everything we talked about is negative. You know, we have negative market data. You know, kids are out doing homeschool, which is driving us all crazy. We're all stuck in our house, can't get out. Most of us can't get our hair cut. Girls are worried about fingernails, pedicures, manicures, and all that good stuff. So, and some guys, I can't say, I've never done that, but there are some guys, I guess, that are worried about that. But anyway, so what we thought we'd do is we wanted to take a few minutes today to kind of shed a more lighter tone or a more positive spin on this particular situation. And, just talk about things that we should be or could be taking advantage of as investors or as borrowers of money. What are some of the things that we can be taking advantage of? That's sort of what we wanted to focus this particular podcast on.
Sounds good. I like it.
So, Eric, why don't you take one? We got a list here, but
yeah. Well, I talked about this. I wrote about this in a recent blog post, but I think one thing that's really fundamental that everyone should do, or should maybe continue to do, I should say, is to continue to invest in your 401k, 403bs, other workplace retirement plans. I've seen some stats where those numbers are decreasing pretty rapidly. It does stand to reason people are losing their jobs. So obviously if you don't have a job, there's not an employer plan that you can contribute to, unfortunately. So I certainly understand that's probably a big part of those numbers. But if you're pulling back on saving for retirement because you want to maintain a little bit of extra liquidity, if you have the ability not to do that, I would strongly encourage you not to do that. Right now is actually a fantastic time to continue to invest and maybe even increase contributions in a workplace retirement program. Reason being is when you look at the value of dollar cost averaging. So for those that might not be familiar with what that term means, that means continuing to invest a fixed dollar amount every single week, 2 weeks, month, whatever that regular interval is, to continuing to invest at a regular pace to take advantage of price fluctuations in the market so that over the long term, you're going to be much more likely to have a gain in your account, which means you invest when the market's up, but you're also continuing to invest when the market is down. And if you continue to invest when the market is down, like it is now, you're going to be able to realize a much greater reward, a much greater return on your money, if you're investing dollars today versus waiting for the market to come back.
It's what you call buy low. Every time we have a major drop in the market, I have at least one person that will call me, should I stop putting money into my 401k? And no, you're buying more with your dollars now than ever. But the second thing you might want to do is you want to make certain that you're taking full advantage of any matches that your company is offering. Because if your company offers a match of, let's say 50% up to 6% of your salary and you're only putting in 3 or 4%, now would be a really good time to up that. Because in addition to you buying low, you're getting free money to buy low to maximize or leverage your contributions. So that would be one thing I would also look at. But also, in addition to that, you might want to reconsider how much you're putting into or what you're investing in if you're close to retirement, depending upon if it's 6 months or whatever. That's another conversation you should have with your advisor.
Yeah, and the other thing
which hopefully is us.
Yeah. If you don't have an advisor, call us. But I would say the other point to the 401k, having worked as an advisor on several 401ks over the years, is that yes, increase your contribution, or don't stop your contribution. That was kind of your point. Yeah. But also, we're in May, and here in a couple of months, you're going to be going through your benefits, and you're going to be able to select your benefits. Well, part of it is about your 401k and that sort of thing, but I would investigate all the options that are available, because there are options that will allow you to increase your contributions every year by like 1%. It's just an automatic increase every year, 1%. But also make sure that you are going into or logging into your account. And, there are some 401ks that you can click a button and sort of have them manage it for you. You can do a rebalance if you want. There's all kinds of different things that you should be doing inside your 401k. The worst thing you can do is make contributions every paycheck over the course of years and never go back in and look at it. You got to, I know it's tough to look at the balance sometimes, especially when you have market volatility like we're experiencing now, but you need to log in to make sure you're still properly invested and that the assets that you're investing in or the funds you're investing in are still solid funds, and that it reflects your current risk exposure. Those are all things you need to be doing in addition to making sure you're continuing your contributions.
But don't be checking every day. That'll drive you nuts.
Well, I was going to say also, if you're unsure about what to invest in, most workplace retirement plans have target date funds. Not that I'm an absolutely huge proponent of those in general. We certainly are not using them when we're managing portfolios, but they are valuable for kind of an everyday consumer, average investor who may not understand or want to put together a portfolio themselves, and or be responsible for continually going in to rebalance or make changes as necessary. That way, if you can invest in a fund that's going to do that with the underlying holdings within the fund itself, it's a little bit more of a hands-off approach that you can utilize. But as long as you're, once again, sticking to your plan, continuing to invest, maybe even increasing your contributions, whether that's to a workplace retirement plan or to another individual retirement account, whether that's Roth, traditional, doesn't really matter, or just even a taxable investment account. We're seeing savings rates, increasing quite a bit through, the last few months. If you've got a little bit more extra money in your pocket, instead of sending it to Amazon or somewhere else, right? It may be taking advantage of, being able to take a dip in the market and buy the dip or buy the low, if you will.
I had a conversation with somebody yesterday, actually it was my wife, that we're finding out that there are some things that we can live without that we used to spend money on 3 or 4 months ago. And so if you have been behind in your savings for retirement, or if you've not been saving at all, and you now realize, well, what, I can do it without some of these things that I was spending my money on, going to Starbucks a couple of times a week, or whatever it may be, going to the nail salon, those kinds of things, that may be stepping on some toes. But
well, you don't want to step on your toes after you've been to the salon. I can tell you that.
But it may be that you can say, you know what, I can live without some of those things. Maybe I can put an extra $50 or $100 out of a paycheck into my 401k plan.
Well, something I talk about a lot with younger investors, and it's the habit, right? It's the habit of investing. You don't always need to be so concerned, especially if you're younger or you have a very long time horizon and you don't have necessarily a ton of money. Don't be so concerned about coming up with the perfect portfolio allocation. Worry about the habit. Worry about saving the $50 a week, the $100 a week, whatever that number is, continually contributing to your investment accounts on a regular basis. Don't break the habit, because once you start to develop that good habit, it is easy to expand upon itself because you start seeing the results. When you start seeing some real results, you can start thinking, oh, I'm doing this with $50 a week. What if I upped it? And then you can start seeing even better results over a period of time. But the most important thing is the habit of investing. Don't break a good habit of continually contributing to your investment accounts.
Very good point.
Yeah, and I think one of the things that you brought up is when you have, which will be a great transition. So when you are younger, or if you were younger years ago and you were, let's say, with a particular company where you were able to buy their stock through employee purchase program, or you just were very disciplined and you were buying, ABC stock over the course of a long period of time, sometimes you run into a situation where you have very low cost basis in a particular stock, and it is appreciated in value, and it can be a challenge when you get older to have low basis stock or have a high appreciation, a low cost basis, highly appreciated stock, and you're kind of stuck with it because you don't necessarily want to sell it because there's capital gains associated with it. So it's kind of tough to maneuver. And I've got several clients that have J.P. Morgan stock. And so that's not an endorsement to buy or sell the security or anything like that. I'm just stating that they actually have the stock, but they have very low cost basis in it. And so one of the conversations that we've been able to have, especially during this time period, is let's go back and consider, reducing our exposure to that particular security because it's pulled back in price. And so you have a lower basis and we're able to get out of it. Now we're doing some lot selling. And if you want to know what that is, make sure you come and contact us. We'll talk about that. But we are going in and liquidating some of the position, but we weren't able to do that back in January. Well, we could have, but back in January, February, it didn't make a ton of sense to do it. But now we're able to go back and do that. As in another example, I had a client who about 10 years ago invested in a particular mutual fund that invested in, it was a fixed income holding, and he had a pretty significant gain. And I had talked with him over the past 3 or 4 years about my concern about him having such a large concentrated position in that one position, and that it was very overly overweighted in a particular segment of the fixed income world. And I kept cautioning him, hey, you need to do something with it. And lo and behold, we come into March and that particular area got hit pretty hard on the fixed income world. So it pulled back significantly. And he went from having a pretty decent gain to where he didn't want to sell it to being in a position where we had to sell the position at a loss. So now it was still kicking off a pretty good dividend. That's okay. But he was now in a position that we could rebalance his portfolio, which is what we did. And we're going to wait because he likes this position. We're going to wait until the market situation is appropriate to buy back into that position. But he's dramatically reduced his risk exposure by taking advantage of what the market was giving him, even though he recorded a loss, and we don't like that, but he's in a much better situation than he was before.
It's so interesting, too, when you see clients with these long-held positions, whether it's from a company they worked for or just something that they started buying when they were younger and they just held on to it, never got rid of it, or maybe you inherit it from your parents, grandparents, something like that. The emotional attachment that clients have to some of these positions is a really tough thing to break sometimes. And I get it. I understand. You have these, you feel like you're almost a part of the company. You do. You own a part of the company. And sometimes it becomes ultimately important in times like these to really evaluate from a less emotional place, from a more logical place, whether or not these positions are truly helping you in meeting and achieving the goals that you have for yourself.
We're in Louisville, Kentucky. We're recording the show. That's where our company's based out of. I mean, we have a perfect example of exactly what you're talking about in folks that have worked at General Electric their entire career, and they were buying stock, they were given stock, you name it, and a lot of those folks were so emotionally attached to that stock, they wouldn't sell it for anything. And it literally went from, I don't know what, 30, 40, 50 bucks or so down to it's like $6 or so, or whatever it is today. But they literally, I couldn't tell you how many conversations we've had about liquidate the position or reduce your exposure, and they just couldn't do it because they felt this emotional attachment to that position. Most of them had a lot of gain in it. Again, another situation that they didn't want capital gains, and so they just rode that horse down to where, the old saying, it just kind of fell over, and that's where they are today. So, again, it's good practice to not get emotionally attached to a position, as Eric just mentioned, but it's also good practice to take advantage of situations that present itself. And market volatility, and we mean market volatility, we're trying to be nice to say when the market pulls back significantly, but take advantage of it. We don't like them, but they happen, and when they happen, take advantage of it. And one of the things you can do is what we call tax loss harvesting, and that is essentially selling positions that had significant gains at a reduced gain, or taking positions that you don't necessarily, maybe you had a little bit of a gain, maybe you had a little bit of loss, but are in a larger loss position, and you can record that loss and then potentially offset that at some point in the future with a gain when the market comes back. So those are, again, just one aspect that is a positive out of all this, and you could take advantage of it.
Well, another part of that is rebalancing which means taking losses in stocks that you can do that or that you no longer want to hold because they've not done well, but also selling positions where you have a gain because you've got now have losses to offset the gain. But you might need to be, some people might find this a good opportunity to rebalance a portfolio because they saw from February 23rd, whatever the date the market was at its high, to March 23rd, they didn't like that level of volatility in their portfolio if they had maybe more stocks than they should have had. One of the things that all of us have found in our business, time in the business, is that people feel more comfortable with the amount of risk they can take on when the market's going up. But we feel losses 4 or 5 times more than we feel the impact of losses 4 or 5 times more than we feel the impact of gains from an emotional standpoint. So if you have been somebody who's been affected by that, oh gee, I took on more risk than I really wanted to, this would be a good time to rebalance and maybe even sell off some of those positions where you have a gain because you can now offset it with a loss and rebalance it into a portfolio that is better reflective of your risk tolerance.
Yeah.
I hope that makes sense.
Yeah. So Eric, one of the things that you had mentioned, and I believe our first podcast was, and I believe that came from an experience you had with a client not too long ago, was or a prospective client had come in and you had mentioned the situation of taking advantage of potentially doing a Roth conversion. So you might just explain what a Roth conversion is and why are we having a conversation with clients now about doing Roth conversions?
Yeah, so to explain what a Roth conversion is, we probably want to make sure everyone's on the same page with what a Roth IRA is, which is one of the best, vehicles available to save for your retirement, is to, invest money after tax. So you've received money from your paycheck, you pay income taxes, you've received the money, it's in your bank account, you invest it in a Roth IRA. It grows tax deferred, but the value, the massive value that a Roth IRA presents is the ability to take distributions in retirement or as retirement income tax-free. And there's obviously a multitude of benefits that are attached to that, namely, of course, fewer taxes you have to pay, which is huge in and of itself, but it also affects the amount of taxes, or rather decreases the amount of taxes that you might have to pay on things like Social Security income, because it's decreasing, because it's not counted as ordinary income when you take those distributions, because it's all tax-free. So there's a host of benefits to utilizing a Roth IRA. The problem with a Roth IRA is there's pretty low contribution limits, $6,000 a year. They increase a little bit when you hit, when you're over 55, but you are handcuffed with the amount of money that you can put into it. And there's so much more, there's much more of an ability to invest in a workplace retirement program, for example, where the contribution limits are far higher. Well, when we have opportunities like today, or like we've been living in the past couple of months, when you have, 401ks or IRAs that maybe you're no longer contributing to, but they're sitting out there, that it's going to be 100% taxable when you go to take those distributions out in retirement, you can look at doing a conversion, converting all or a portion of those IRA accounts into a Roth. The reason why it's a valuable concept to look at doing today is because essentially Roth conversions are on sale. What I mean by that is because with depressed values in your IRA account, assuming, with the market down, it's probably safe to assume there's some losses in a lot of our IRA accounts out there. If you have losses in your IRA account, in order to convert to a Roth, you want to go ahead and basically, instead of paying taxes at a future date, at a tax rate to be determined, you can pay them at the rates that we have today, which we know for a fact are artificially and historically low. So you want to go ahead and, take a distribution. Essentially, it's not necessarily taking a distribution. It's converting it to a Roth, but it's treated as a taxable distribution. You have to pay taxes on whatever you're going to convert. So say, for instance, if you have a $100,000 IRA, if you're going to convert, let's just, to make it easy, convert all of that to a Roth IRA, you're going to have a $100,000 tax liability. It's going to be treated as ordinary income. Whatever your tax rate is, let's say you're in the 25% tax rate, you're going to have to pay $25,000. Okay, taxes are a part of life. You were going to have to pay pay those taxes later on in distribution. You might as well just pay them now. The reason why you might want to consider doing that now is because tax rates through 2026 are artificially low. We know that everyone is going to get a tax increase in 2026. The tax cuts that went into effect in 2017 sunset in 2026. Depending upon the different tax rates or the tax rates that you fall in, you could be getting a tax increase of 5-7% in 2026. All that is to say, we've also had massive increased government spending as a result of this pandemic. We've already had a $2 trillion stimulus bill. We are seeing now proposals for another $3 trillion in stimulus. We've had a national debt that has gone from about just under 10 trillion, a little bit of a difference there, $10 trillion in 2008 to now over $24 trillion today in just a matter of 12 years. The government only makes money one way, and that's through taxes, and they have to pay off that deficit. They have to pay off that debt, right? So in order to do that, there's probably a good chance that the tax rates that we have now are not going to last beyond 2026. So if we have that same $100,000 IRA, it's now decreased, let's say, to $80,000. Well, if you were going to convert it today, instead of paying a 25% tax rate on $100,000, you're paying a 25% tax rate on $80,000. So it's actually cheaper. That's why I said they're on sale now. Roth conversions are on sale. It's cheaper to go ahead and do it today if the value of your IRA is depressed.
And I think the other thing that's important that we just added that is you gave the example of a $100,000 IRA. It's maybe decreased to $80,000, and you're going to convert that, and you're going to pay tax on the $80,000 versus leaving it in your IRA, letting that $100,000 potentially be $200,000, and now you're going to pay. Let's assume the tax rate stays the same. Now you're going to pay 25% on $200,000, as opposed to getting it on sale at $80,000. That's one of the that's one of the luxuries of it, of what we're talking about. The other thing that which also has an impact is, and we're not necessarily saying that you convert 100%. You can convert some portion of what your IRA is. However, one of the aspects of the planning process that we talk about with clients is the impact of required minimum distributions when you reach now the age 72. That may change, but they just changed that from 70 and a half to 72. But and that could potentially change on the road. We don't know. But the impact, I see clients that are having to take out massive amounts of required minimum distributions when they don't even need the money. But yet they're still having to take it out. So the more you can get out of your IRA or out of that pre-tax bucket and get it into that after-tax bucket, which the Roth IRA is considered after-tax, which are the tax advantage that you talked about. The more you can get out of there, the less impact you're going to have when you reach 72, which would, is the money that you're going to be forced to take out at a potentially higher tax rate. So it's a great idea to consider doing Roth conversions.
What we can help people do is reduce their lifetime tax bill. As you say, that RMD, if you run that out to age 85, 90 years old, more than half of people who retired at 65 will live to be 85 or older. There's a massive amount of tax savings that we can help people with, but we don't just take shots in the dark. We have software that will help us figure out how much of an advantage it would be. We have to make assumptions about future tax rates, but we use software to make those projections.
Yep.
So one group of people who could really benefit by converting to Roth IRAs, partly because the market's low, but even after it rises, are people who are several years away from that age 72. They could be age 60, 62, 64 years old, especially if they are working less, earning less income, maybe semi-retired. But there are a couple of other classes, groups of people that could really benefit from a Roth conversion. If somebody's in their 30s or 40s and they can convert all or part of a 401k or an IRA into a Roth, you could have 20, 30, or 40 years of tax-deferred growth in that Roth IRA.
Yeah.
Someone who has looked at a Roth conversion in the past but hasn't because of their tax bracket might be in a lower tax bracket this year, because I know some people have taken reductions in income. Some people have lost their jobs temporarily, hopefully. So if you know that you're going to have a lower level of income this year, that would be another group of people that might potentially benefit, because you could do a Roth conversion and it's not going to kick you up into a higher tax bracket.
Yeah. So the other thing that that I have a lot of conversations with clients about, especially those that I'll back up. So Eric was talking about, described what a Roth IRA was, and one of the aspects of a Roth IRA is that not everyone can contribute to it. Those that exceed certain income limitations are excluded from making direct contributions to a Roth. So I think as a couple in 2020, a couple that makes above 100 adjusted gross income, or modified adjusted gross income of above 192,000. I realize that's a big number, but still there's folks that make more than that. Modified adjusted gross income above 192,000 phase out of the ability to be able to contribute directly to a Roth. And so what we have conversations with clients around is, can we look at potentially still contributing to a Roth, but we have to do it through a process called a backdoor Roth IRA. And one of the steps in the backdoor Roth IRA is that you have to clear any account, any IRA account that you have. It does not include money that you have in a 401k. So if you have money in a 401k, we're not talking about that. That's an active account. You're a participant in a retirement account. That money doesn't count. But let's say you moved jobs 10 years ago and you got an IRA. It's got $50,000 in it. That counts. So if you exceed the income limitations, you first have to convert all that IRA money out into your Roth and take, that'd be taxable event, but you'd have to clear that account out first, or do that entire conversion before you could begin the backdoor Roth conversion. So this is a great time, again, to have that conversation we were just talking about, doing the Roth conversion. Now, there's other steps that we can put in place, maybe potentially moving that amount back into your existing 401k or some other things. But once you have all your money, your retirement or pre-tax dollars, either in your 401k, you're actively a participant in your 401k, or you've done a full Roth conversion, you can then look at potentially doing a backdoor Roth IRA. How it works, it's pretty simple, is if you exceed the income limits and you're not eligible for a direct contribution, you can then make a non-deductible IRA contribution every year for the maximum. So this year it's $6,000 if you're younger than 50. If you're over 50, it's $7,000, right? So you're able to put in $7,000 into an IRA, and then that money is then converted, usually the next day, over to your Roth. So in effect, you can still contribute to a Roth. It's just a hopscotch game, right? You have to just go through an IRA to eventually get to your Roth. There's some little bit of tricks around it. And so you have to make sure that things are set up properly. You have to make sure you have no IRA money. That's kind of the key. But as long as you don't, and we can help you through that, we can walk you through how you're set up and the best way to accomplish this. But again, backdoor Roth IRAs are huge. I probably do 30 or 40 of them a year for clients that exceed those income limitations. And the only way we have been able to do that is if we did Roth conversions, and we did them all back in 2007, 2008. That's why we're talking about it, because we did a ton of them back then, and now these folks have been able to, over the last 10 years, do backdoor Roth IRAs.
I think we need to add one point. Technically, you could have a backdoor or a non-deductible IRA and a tax-deductible IRA at the same time, but that causes major headaches when you start to take money out, take distributions out down the road. That's the reason why he says convert all of your money in an IRA to a Roth before you begin doing the backdoor Roth conversions.
Yeah. Okay, so one of the other pieces of the financial world that you can take advantage of during market volatility, and we mentioned this during the last podcast. So if you didn't catch that, make sure you go back to our podcast page and catch last week's show. We talked about just gave a general market update, and one of the things that we talked about was when you're looking at market numbers, especially if you're watching CNBC. You look over in the right-hand corner, and they're always flipping these numbers. They're showing the Dow and the S&P. One of the things they'll show constantly is the 10-year Treasury. And the reason why they show the 10-year Treasury is because it impacts borrowing rates. They also show maybe the Fed funds rate, as we mentioned again in the last podcast. The Fed funds rate is just the overnight borrowing rate for banks. But what the banks do, and that really doesn't have any direct impact on you and I borrow money on our equity line of credit or on a mortgage, but the banks are pretty smart. They just pass those costs along, right? I mean, if they have to borrow money overnight, they're going to turn and pass it along to all of us in the form of higher loan rates. But it really shouldn't impact it, but it does. But especially today, so again, today is May 15th of 2020. When you turn on CNBC and you look down the far right-hand corner and they're flipping by and you see the 10-year Treasury at 0.63, I think is what it was yesterday or what it ended yesterday. That tells you what the interest rate is on a 10-year Treasury note. Banks lend money based on 10-year Treasury. Typically, mortgage rates are based off a 10-year Treasury. So when the 10-year Treasury note drops in price, borrowing rates drop in price. So the 30-year mortgage rate, and the 15-year too, the 30-year Treasury or the 30-year mortgage rate drops in price. That has the opposite effect too. So when 10-year Treasury goes up, typically we see that mortgage rates go up. So this is a great time that if you're listening to this, it's a great time to look at your current mortgage, and if you have a rate that's if you got decent credit, and you know you're rates above what 3.5, especially 4. But if you're above 3.5, you really need to reconsider doing a refinance on your mortgage. Now, here's one thing I will tell you: when you call your mortgage lender or you call any lender, they're typically just going to quote you a 30-year mortgage. But if let's say you're 5 years into it, right? So you have the 30-year mortgage, and now you've paid 5 years, and you want to keep your amortization on the same schedule, you can do that. Typically, the lender is going to say, no, just do 30. No, you just say, no, I want to keep my schedule the same. So I want to keep it at 23 or 25 or whatever. They can do that. All they're doing is refinancing the interest rates, all they're doing. But it's a great opportunity to evaluate whether you need to do a refinance.
Yeah, a couple of things you might want to keep in mind. When you go to refinance your home, maybe not all, but most mortgage companies will appraise your house. Some people may say, well, I don't want to do that now because house values are down. Not in this part of the country anyway. Yeah. The real estate market here is still very hot. People are buying houses. The problem is there's not that many people selling houses. So they will appraise your house. And you mentioned you want to make sure that your credit's in order to do something like that.
Or maybe if you think there's going to be something happening in the real estate market, probably doing it sooner than later before there is a decrease in the value of your home might be something to think about doing as well.
Yeah, and
if you're thinking about moving.
Well, I'm just saying if you're worried about the value of your home not being appraised for what it is, being able to qualify for a refinance for a new mortgage.
Yeah. And here's the one thing I will tell you that that comes up quite a bit. I actually had 2 clients last week, that called me and said, hey, I've taken some money out of the market, and, I'm waiting to put it back in the market, but also have a mortgage. Does it make sense for me to take that money out of the market and pay off my mortgage? We're going to do an entire podcast on that because I certainly have thoughts on that. But and these guys are giggling because they know my thoughts because I say it in front of clients all the time.
I have the same thoughts too.
Yeah. So don't necessarily assume that because we're in market volatility and you have a bunch of cash that you should take that money and go pay off your mortgage. We can walk through this at another date, but I think the numbers are going to tell you something totally different.
I also do want to add, though, if we're going to talk about refinancing, we're not necessarily talking about taking cash out, doing a cash out refinance either.
Oh, no.
We're just basically talking about refinancing your current mortgage, staying on your current schedule. It is worth noting, if you are going to take cash out, the rates are usually not as good, especially right now. There's actually getting a pretty...
Yeah, you get bumps. You get bumps in your rate.
You're going to get a bump in your rate if you're going to take cash out, so it's actually not as advantageous to try to access capital like that. That's kind of a last-ditch emergency type thing. I don't recommend that.
All right, so the last one we want to talk about, and this is going to be an unusual one that we're going to talk about, but I do see it as a positive. And what we're talking about is, we're talking about annuities, okay? So annuities have that kind of love-hate relationship. And there are advisors that, we say this on the radio, or when we had the radio show, we said this all the time. There are advisors that you hear on the radio, see on TV, and they think annuities are the end-all, be-all, and the greatest things in the world, and everybody needs them, and you need to have 100% of your money in them, and you'll hear that day in, day out. Then you're going to have some annuities or some advisors. There's one that advertises on TV, and we all, you know his name, but he literally says annuities are the devil, and it's the worst thing in the world. And I will tell you that we view every investment vehicle like they should be viewed, and that is, it is a tool in a toolbox, and at some point you're going to need a tool. You need that specific tool to fit that job you're working on, and that's how we view it. If annuity makes sense for the right situation, for the right client, then annuity can make a ton of sense. It's not right for everybody, and it's not right for all your money, but it could be for the right situation, for the right client. It could be an investment vehicle that makes a ton of sense. I just happen to believe that given the market conditions that we're in now, which is very, well, I would say super low interest rates, but essentially we're in zero interest rates, right? If you have cash on the sideline, they're earning nothing right now. 2 months ago, we were at least earning maybe, 1.5% in your checking account or savings account, high yield, and now it's zero. So an annuity positioned the proper way in a portfolio can make a ton of sense. The reason I say this is because it is May 15th. I don't know why I'm stuck on March. It's May 15th, and I have a high yield checking account that I got online, I don't know, probably 2 years ago, that was paying like 1.75 even as late as February this year, and now it's paying 0.01. So I had a client that came in a couple of weeks ago that had some cash, same situation, had some cash in a high yield money market account that started paying zero, and said, what can we do with it? They didn't need the money for, I'd say, about 5 and 10 years, they're about 55, or she's about 57. But anyway, had plenty of time, just wanted to do something with the money. She had plenty of money in the market. We didn't need to put anything else in the market, but there's just extra cash she had. And so we looked at doing a fixed indexed annuity. So there's two aspects of that. Number one, she wanted something that she wasn't worried about market volatility. So again, annuities a great solution for that, because if she put in $100,000, that $100,000 is always going to be hers, not going to go anywhere. But because the markets have pulled back, she had a great opportunity over the next 5 years, this was a 5-year product, to participate in the appreciation of the market without having the downside potential. So we took money that was in a money market account paying 1.5% 2 months ago, now paying nothing. And now we've transitioned it to another money market. It's not a money market account, it's an annuity, but it's a very similar product. No principal volatility, but has the participation of the market over a 5-year period. And we could potentially pick up, 2 or 3 times what she was going to get in that money market account, just because of the market conditions that we're in. So again, another situation where market volatility, you can use it to your advantage and find out what products are available that might give you some market stability or portfolio stability or principal stability but also give you some upside potential. So it was a great solution for her.
There are some investments that 4 or 5 months ago you might not have wanted to look at that may make more sense now to look at. But secondly, what he just said is not an endorsement for any individual to buy a fixed index annuity. There are actually a number of different types of annuities, and we're not promoting a certain product. We need to make certain we make that disclaimer.
I think the important thing to remember, and you just said this, I'll expand on it, it's a tool. It's not our only tool. This isn't a place where, we have, the only thing we have is a hammer and everything is a nail, right? That's not the case here. It is a tool. In the toolbox, we use it on occasion. There are some instances where it makes really good sense. There's a lot of instances where it does not. But it's definitely something that we have at our disposal. And to your point, especially in a market with depressed interest rates, when you're trying to find a place, to find any kind of value for your quote unquote fixed income assets, this is a new alternative that we can look towards to solve that problem, to fill that gap.
Yeah, and I think the point of the podcast today is really just to put a positive spin on, really, if you watch the news, can be a very negative situation, right? I mean, there's hardly any good news. And if you watch news, which I'm not sure it's news, there's got to be more.
Mass media.
Yeah, it's mass media. I don't know how you really phrase it. But anyway, there's not even positive news there. I mean, it's just one political negative thing after another because we're in a election year, so we expect that. But then we have the markets on top of it, which is really almost no good news coming out of the market. So what we're trying to do is put a positive spin on it, and I think we've done that. And are there other situations where there's positive news coming out of the markets? Absolutely. We talked about it in our last show. So if you didn't catch that, go back and listen towards the end. I think we talk about the information technology sector has actually performed really well. There's stocks that have done really, really well. But again, the point behind this is just to be more optimistic, kind of be that glass half full kind of guy, which we all are, and things that we can actually take advantage of while we're in market volatility. So again, just make sure that that you're taking advantage of the situations. And to Tad's point, when we talk about annuities, that's not an endorsement to buy or sell, as a full disclaimer. You have to know your particular situation. And if you're listening to the show and you don't currently do business with us, we don't know whether annuity is right for you or wrong for you. We have absolutely no idea what your personal situation is, what your risk assessment is. But if you want to call us and you want to give us that information, we're happy to walk you through that to determine if an annuity might be right for you, or any widget for that matter. It doesn't make a difference. But we have to understand your particular situation before we give you any investment advice. So please don't take anything we say as investment advice for you specifically, because we don't know your situation. So, but again, if you want to call us or come in and see us, we'll be happy to get to know you, and then we can provide you specific
Our
advice.
phone number is 502-233-9800.
Yeah, you can come. Call us, because right now we may still be in quarantine and may not be able to meet with you. But anyway, anything else to kind of wrap up the show today, guys?
Well, I would like to just add on to what you said. So many people we talk to, both clients and prospects or just friends, kind of want to crawl under a rock or crawl under their sheets and pull them up when it comes to their investments or finances. And they don't even want to think about it. They don't want to talk about it because they're paralyzed. There's no need to be paralyzed. There is always something we can do to help you improve your financial situation. There's always something out there, whether it's a tool or a strategy. There are things that we can do that can help you position yourself better for the future, position you hopefully for the next bull market. But there's always something we can do to help you financially.
Eric, any final thoughts today?
Final thoughts as we start to wrap up. If you're watching on YouTube, please subscribe.
There you go.
If you're listening to a podcast, please leave a review. Please give us a like. We appreciate it.
Yeah, well, so catch us next week. We do these on a weekly basis. Make sure you check out our website, FamilyWealthPlanningPartners.com. That'll pop up here on the screen. Eric also does a podcast of his own, Unscripted Finance. Make sure you check that out. It's great info. Check back to what's ours? Our
website.
No, it's our website. Peace of Mind Radio is what we've put these podcasts on. That's what I was kind of remembering. Anyway, I appreciate you watching. I appreciate you listening, and we will talk to you guys next week.
Thank you.
Thanks. The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as Independent Financial Partners, IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide any tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. Securities offered through IFP Securities, member FINRA, SIPC. Investment advice offered through IFP Advisors, LLC. Doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated.